welcome back. You're listening to Passing the Baton. I'm Jared Hight from Tracktown Law. We're a virtual law firm based in Eugene, Oregon, serving clients across Oregon and Idaho with modern, flat-fee estate planning and business services. Virtual, straightforward, and built for clarity. A quick disclaimer before we begin. I'm an attorney licensed in Oregon and Idaho, but this podcast isn't legal advice and doesn't create an attorney-client relationship. If you need guidance on your specific situation, talk to a lawyer, ideally one who understands estate tax and doesn't glaze over when you say irrevocable. And if you haven't already checked it out, Tracktown Law now has a companion blog for this podcast. Every episode is available as a full written post at tracktownlaw.com. Whether you prefer to read, need a refresher, or want to share a topic with someone else, it's all there. The blog post for today's episode is live now. So today we're diving into something deceptively simple, your life insurance policy. More specifically, why it might be doing your family a disservice by accidentally inflating your Oregon taxable estate, and how something called an ILIT can fix it. Let's start with the problem. Most people assume life insurance proceeds are tax-free, and they're right, mostly. The death benefit from a life insurance policy is not subject to income tax for your beneficiaries, but it's a different story when it comes to estate tax. If you own the policy yourself, the full value is included in your estate when you die. In Oregon, where the estate tax exemption is just $1 million, that can quickly cause issues. Let's say you've got a $750,000 life insurance policy. Not extravagant, just a solid cushion. Now add your home, retirement savings, and other assets, and suddenly your estate is well over the $1 million threshold. That means your beneficiaries might owe Oregon estate tax, even though you assumed the life insurance would pass cleanly to them. This is where the Irrevocable Life Insurance Trust, or ILIT, comes in. An ILIT is a special type of irrevocable trust designed to own your life insurance policy outside of your estate. The idea is simple. If you don't own the policy, it doesn't get counted as part of your taxable estate, but you still get to choose who benefits from it and under what terms. Here's how it works. First, you create the trust. It must be irrevocable, meaning you can't dissolve it or take the assets back once it's set up. You appoint someone else, usually a family member or a trusted advisor, as the trustee. Then, the trust applies for and becomes the owner of the life insurance policy. Second, someone has to pay the premiums. Since you're not the owner anymore, you can't just keep paying the insurance company directly. Instead, you make annual gifts to the trust, and the trustee uses those funds to pay the premiums. Now here's where things get technical but important. To avoid triggering gift tax or using up your lifetime exemptions, those annual gifts to the ILIT need to qualify for the federal annual gift tax exclusion, which is $19,000 per person in 2025. But there's a catch. Gifts to trusts don't automatically qualify for that exclusion because the IRS requires the gift to be a present interest, meaning the beneficiary must have the immediate right to use or enjoy the gift. If you just drop money into a trust for future use, it doesn't count. So how do we fix that? Something called a Crummey power. A Crummey power gives each trust beneficiary the temporary right to withdraw the contribution you've made to the trust, usually for a short window, like 30 days. The beneficiary receives a notice saying you have the right to withdraw $18,000 from the trust right now if you choose. In practice, they don't take the money, and if your beneficiaries understand the purpose of the trust, they usually won't. After the withdrawal window expires, the trustee uses the funds to pay the life insurance premium as planned. This temporary right to withdraw, even if it's never used, is enough to qualify the gift as a present interest, which means it falls under the annual exclusion and avoids gift tax consequences. That's the brilliance of Crummey powers. They take something future-focused and make it qualify as a present interest gift, all through a simple legal notice. And yes, it's named after a real person, Clifford Crummey. He sued the IRS in the 1960s and won, so here we are. All that being said, this arrangement ensures these gifts to the trust fall under the federal annual gift tax exclusion, so the amount doesn't toll against the federal estate and gift tax threshold of $14 million per person as of 2025. Remember that Oregon doesn't have a gift tax, so it doesn't need an exclusion. If your estate isn't in danger of exceeding the federal threshold, these gifts can be made simply and without this procedure. Let's step back and look at what you've built. You now have a trust that owns the policy, pays the premiums using tax-free gifts, and receives the death benefit outside your taxable estate. That benefit can then be distributed by the trustee according to your terms to support your spouse, your kids, or even to fund buyouts or charitable bequests. And because the ILIT, not you, owns the policy, the Oregon Department of Revenue doesn't count it toward your estate. That could be the difference between leaving $500,000 tax-free and your heirs handing a chunk of it over in estate tax. A few cautions though. If you transfer an existing life insurance policy into an ILIT, there's a 3-year rule. If you die within 3 years of the transfer, the IRS pulls the policy back into your estate anyway. That's why ILITs work best when they're created before you take out the policy, not as a cleanup move after the fact. And as with any irrevocable trust, you're giving up some control. You can't change beneficiaries on a whim or take out policy loans. Once the policy is in the trust, it belongs to the trust. That's the trade-off, control for protection. Still, for many Oregon residents, especially those with mid-sized estates and significant life insurance, an ILIT can be the thing that keeps your plan intact and your heirs out of tax trouble. In episode 16, we'll look at credit shelter trusts, a strategy married couples can use to preserve both spouses' Oregon estate tax exemptions. If you're married and your combined estate is anywhere near the $1 million mark, you'll want to pay attention. In the meantime, the full write-up for today's episode is available at tracktownlaw.com. It's a great resource if you want to revisit what we covered, or if you want to share this with someone you know who has a big life insurance policy and no idea what an ILIT is. While you're there, you can explore flat fee pricing or schedule a free consultation. Thanks for listening. I'm Jared Hight from Tracktown Law, and this has been Passing the Baton.